So, John, we're now talking trust and estate preparation.
Yep.
So what exactly is that in terms of how you guys are involved? I mean, taxes, accounting, all that.
Yeah,
But
it's everyone's favorite subject.
yeah, I've been waiting. Right? I've been waiting for this one
with bated breath.
Definitely, yes.
So part of kind of estate planning in general, right, is often kind of creating additional vehicles to pass money to future generations and avoid probate, right? Probate is a court, and if you pass away without a will and you have no trust, all of your assets essentially go into probate, and it can become very lengthy and, more importantly, very expensive. So if you are over a certain dollar threshold, pre-Tax Cuts and Jobs Act in 2017, that dollar threshold was somewhere in the $6 to $7 million range.
Okay.
If you had a spouse, it doubled, so it was twice that amount. Post 2017, it is now in the $13.5 million range, and if you have a spouse, it is $27 million. If you exceed those thresholds, you have to file Form 706, which is where you tell the government, here are all of the assets that I own. If you're under that amount, often you can get away not filing. Some people still want to because they want a statute of limitations.
Okay.
So if you have big assets that appreciate in value or will appreciate in value, you want to ensure that the IRS says, we've received your form, we agree, this was the value. Because then at some point in the future, if they try to contest and say, well, this was worth $40 million 10 years ago, you can say, no, we filed the form. You said it was worth $8 million.
Okay, good strategy right there.
Yep.
Then, huh?
And so it's a good way to kind of solidify your the basis of some of your assets. A vast majority of people will ultimately not need a 706, which is for those larger estates, but they may need something called a 1041, which is for your income items in that estate. So if your estate has a bunch of investment activity or they have brokerage accounts, those may throw off capital gains, capital losses, interest, dividends. If you sell a home, right, there may be a gain on that home. Or if you sell other property, you may have gains on that other property. All of those things are ultimately recorded on an income tax return for an estate. And so we prepare those returns, whether it's a 706, whether it's that 1041, gift tax returns as well. We prepare all of those types of returns. And so the most common probably is going to be that income tax return for the estate, which is something that many people need. Second is probably going to be those gift tax returns because folks are starting to kind of see in 5-10 years, maybe they're trying to plan out where their assets are going to end up. So they're starting to make those gifts, and depending on the size of the gift, you may need, again, just like with that 706, you might need to submit to the IRS and say, here's what we're gifting, here's what we're saying it's valued at, do you agree? The IRS generally will, if it's a big enough
You
item,
would suggest doing that, right?
Yes.
By the way, I
absolutely.
Get that.
Yeah. And so that's one of those things where ensuring that you have a paper trail for assets, especially assets that appreciate over time, making sure that we have documented, here's what we believe the basis is, means that the IRS has no choice but to acquiesce and use those basis numbers unless they challenge it. And they will challenge some of those larger items, but generally speaking, those items are not challenged. Gifts over a certain dollar amount, so it's indexed for inflation every year, but over a certain dollar amount, generally $18,000 right now are required to be reported on a gift unless you elect gift splitting with your partner, which means that you both get that exemption, so you would essentially double what you're able to give. Those are required to be reported as gifts on a gift tax return. It's something that, generally speaking, few people do, either because they don't know or because the definition of a gift can be a little bit
vague. Okay.
Yeah. So if you give someone cash over the course of a year, are you going to be keeping track of every penny you give them? Probably not. It's one of those things, too, where charitable contributions on an individual tax return, theoretically, are also gifts. So if you start getting close to these thresholds, right, and you start, let's say you take your family on a vacation, are they reimbursing you? Perhaps
a vacation
not.
Could be considered a gift.
Could be. Yep. In the right context. Yeah. And so you start thinking about all these different ways that, or all these different items that may be considered gifts, and then those forms start to become a little bit more important.
So if somebody is watching this very charitable type person, it's probably good to talk to you guys just to make sure.
Absolutely.
And how does that happen though? Because folks with that kind of income, they've probably been working with people. How does it? They go, you know what? I need somebody else, and
You'd be surprised. So folks with that kind of income, some of them will be working with professionals, others won't be, right?
Okay,
Either because they've inherited something
Okay,
and they're
yeah.
now becoming a little bit more generous because they have some additional funds.
Yeah.
Maybe they're just now getting to a point where that income level is approaching where they feel comfortable making those larger charitable contributions, or they're getting to a point in time where they've been comfortable, but now they're looking at asset management and they're trying to start shifting these assets to the next generation or to their grandkids, right? So putting money into a 529 plan for your grandkids, that's a gift. And so that's something that if it's over that threshold, is we report it on one of these forms, we memorialize it, and we send it into the IRS. So there's also a ton of planning we can do from a trust standpoint, right? You've got grantor retained annuity trusts, you've got ILITs, which are life insurance trusts. There's a whole bunch. It's acronym soup. So you got GRATs and GRUTs and GRETs and ILITs and all sorts of fun things.
EIEIO, Iowa.
Yes,
Wow,
right. It's like
moly.
Old McDonald had a farm.
Yeah.
But essentially, as you start getting into this asset transition or the desire to have an asset transition, those types of plans, figuring out what trusts may become the most beneficial from a tax perspective to ensure that the taxability of those assets is as minimal as possible. That's where we can step in and we can provide some significant value.
Do you work with a lawyer then with the trust and strategizing?
Yes.
That? Okay.
So and we have tax attorneys that we like to work with, and then
Yeah.
we can't write the trust documents themselves.
Sure.
So we can have input, and we do have input as to which assets are going to go, when they're going to go, whether or not they're going to the first generation or to the second generation, because there are generation skipping taxes potentially involved, right? So that's GST. That's another fun acronym.
How many are there?
Hundreds.
Okay, all right.
So you have all of those considerations, and then the attorney will draft up the trust document to memorialize the plan that we've all kind of agreed on.
And taxes, obviously, with trust, that's
Yes.
the biggest. That's the biggie. I mean,
It is a biggie.
I mean, obviously,
Yes.
who's going to have access? But I mean,
Yep. Yeah, and so then depending on the type of trust, right? So there are simple trusts, there are complex trusts. The trust itself will likely have some sort of a tax liability as well, or a tax, at least preparation requirement. So those GRATs, the grantor retained annuity trusts, those are a little bit different. Often, if you have someone putting something into a trust, but they retain the right, then it's going to go on their individual return. If they put something into a trust and they no longer have the right, then generally that trust itself is going to need an income tax return done. And so we do both those grantor retains, where we kind of help figure out, okay, this is actually going to be reported on your income tax return. And then the other types of trusts where we say, this needs its own separate EIN, it's going to need its own entity return. We help prepare those as well.
it's pretty complicated, but
It is.
you make it easy.
Oh, always.